Well, good afternoon. Happy Friday, May 23rd. Mark Milam here, your mortgage professional. Let's get right to it. Not a super fun week in the world of mortgages. In fact, it was this time last week that we were about to get some news out of Moody's that was going to downgrade the United States credit from AAA down to AA plus. So the other two credit rating agencies, Standard & Poor and Fitch, have already downgraded the United States credit as a result of ballooning deficits. And then we saw the last link in the chain here. Moody's do the exact same thing last Friday, did it about 10 minutes before the close of business. And of course, that was somewhat strategic, but all through the weekend, we were wondering how the bond market would open. Of course, it was significant as we moved throughout the week. Some people have said, hey, this isn't that big of a deal, right? Going from AAA down to AA plus. And from a credit perspective, maybe not, but from a sentiment perspective, every single time we pile on yet another thing that might call into question the value of the United States debt, well, then that's certainly not good for interest rates. That's not good for mortgage interest rates in particular, and that's not good for housing affordability. So the first body blow that we took was this time last week when Moody's downgraded the United States credit. What happened after that wasn't any more favorable. On Wednesday, we had a 20-year bond auction. In the past 6 bond auctions, we've seen the 20-year yield be about around 4.6%. This particular bond auction saw rates get up to over 5% on the 20-year auction. That's a lot of upward pressure on long-term instruments. That puts more upward pressure on mortgage rates. And not to be outdone by the 20-year bond auction and by Moody's downgrade, we had the big, beautiful bill, the President Trump's bill, to pass through Congress. This is a spending bill, and it passed through the House. I believe it was late Wednesday night, moving into Thursday morning, and now it moves on to the Senate. And it's widely projected that this bill is going to increase the federal deficit. Here's what mortgage-backed securities look like over the course of the week. This downward trend in mortgage-backed securities is not what we want. We want to see things going the other way, where interest rates would be improving as the value of the security declines. This right here is Wednesday. That's when we got the bulk of the bad news. We got the 20-year bond auction. Saw a little bit of a rally back yesterday and a little bit more today, although on the whole, the week has been moving in the wrong direction. If we take a look at some headlines here, this is the Moody's downgrade. It signals a deeper risk for U.S. debt. Now listen, does that mean the United States is going to default on its debt? No, of course not. But it does mean that, hey, the risk of the United States debt is growing, and we don't see anything in line that would show us that the United States is getting its act together to have a balanced budget, right? There's nothing there that would give credit rating agencies any sense of security that we're moving back towards a balanced budget. And so hence we get the third credit rating agency that has now downgraded United States debt. And this is the 20-year bond auction. We see the Treasury auction goes badly, meaning rates are high. Yields on Treasury spike as a result of bonds sell-off. And this is finally from CNBC. The Republican spending bill is sending yields, this is bond yields again, soaring and creating a major market headache that's estimated that we're going to add about $3.8 trillion to the national debt as a result of this spending bill, which increases spending, puts into place some tax cuts. All of that just results in more debt. And that means we have to issue more and more treasuries to fund our government. That puts upward pressure on rates. Just not what we need. What we're looking for here in the bond market, which is the 800-pound gorilla in the room, is austerity. That's the word that we're looking for, is austerity, financial responsibility. And if the bond market could see that, we would certainly see yields start to come down. We would see interest rates start to come down, and that translates into home ownership affordability. But until we get that, unfortunately, we're seeing rates elevated, and now a no-points rate on a 30-year fix is getting upwards around 7%, and that is not what consumers want to hear. If I can be of any service to you over the holiday weekend, don't hesitate to reach out. Mark.Milam at HighlandMTG.com. Have a good weekend.